So, what if one of the biggest banks in the world was secretly on the brink of collapse? And what if it was all because of a massive hidden bet on the price of silver? Well, an explosive new document has allegedly been leaked, and it details an emergency meeting at Citigroup that could potentially send shockwaves through the entire global silver market. Today, we're going to break down exactly what this leak claims and what it could mean for all of us. The whole story comes from a YouTube channel called Bullion Watch. They claim to have their hands on a full 73-page document, the minutes from an emergency board meeting at Citigroup. Now, here's a really curious detail from the source. They claim this meeting took place on a future date, January 8th, 2026. So for this explainer, we are simply presenting the claims exactly as they were laid out in that source material. Okay, so the heart of this whole thing is a real bombshell. The claim is that Citigroup's board issued a mandatory, no excuses order to liquidate its massive silver short position. Now, in plain English, that just means they had this colossal bet that the price of silver was going to go down, and now they're being forced to unwind that bet, and fast. And when we say colossal, the size of this position is, well, it's almost hard to wrap your head around. According to the source, we're talking about 6.3 billion ounces of silver. To put that in perspective, that is almost 8 years of the entire planet's mining production. Just wow. The source goes on to claim that the board set what seems like a completely impossible deadline, February 1st, 2026. That gives them just 23 days to get out of this gigantic position. So you have to ask, right, what on earth could force a bank to make such a drastic and, frankly, dangerous decision? Well, the alleged document points to 3 existential crises hitting all at once. According to these supposed meeting minutes, the board wasn't just dealing with one little problem. No, they were staring down the barrel of 3 separate, absolutely catastrophic risks that made holding the silver position completely impossible for the bank. These 3 alleged threats were: 1. An insurance cancellation that would literally make their position illegal. 2. A credit downgrade that would spark a funding crisis. And 3. A criminal investigation aimed right at the bank and its top people. So let's dig into each one of these. Okay, first up, the insurance crisis. The source claims that the bank's main insurer, the famous Lloyd's of London, sent them a notice saying this massive silver position was, and I quote, uninsurable, and that they would not be renewing their policy. With that policy set to expire on January 31st, the bank would suddenly be in violation of federal banking regulations, making it flat out illegal to even hold the position. Then there's the credit threat. The ratings agency Moody's had allegedly put the bank on what's called a rating watch negative. That's basically a warning shot, signaling they're about to downgrade the bank's debt. And a downgrade, well, that's a huge problem. It would make it so much more expensive for Citigroup to borrow the money it needs for its day-to-day operations. It could cripple them. And the third crisis, according to the source, is a legal nightmare. They claim the bank got a target letter from the Department of Justice. That's the DOJ officially telling them they are the subject of a criminal investigation into manipulating the silver market. So the bottom line here is that the board was allegedly cornered, facing a regulatory shutdown, a financial crisis, and potential prison time for executives, all at the same time. Faced with this absolute perfect storm of threats, the source claims the board was left with no choice. They had to make a drastic and unanimous decision: get out of the silver position no matter what it costs. Now, just look at these numbers. According to the source, the board knew that trying to unwind this position so quickly would likely cause the price of silver to explode to $267 an ounce. And they calculated that this would cost the bank an estimated $143 billion. And yet they supposedly voted unanimously to do it. Why? Well, because the alleged alternative, the complete and total failure of the bank, was even worse. This is a really complex story, and it has some enormous potential consequences. If you like our videos that help break these things down, please take a quick moment to like, share, and subscribe to follow us. That way you won't miss any of our exciting updates. All right, let's get back to the impossible math of this whole situation. So, the big question is, how would a bank even start to buy back 6.3 billion ounces of silver in only 23 days? According to the source, the bank's own internal analysis, which was supposedly presented to the board, showed that it was a mathematical nightmare. And this right here really shows you the scale of the problem they were allegedly facing. To meet that deadline, Citigroup would supposedly need to buy 275 million ounces of silver every single day. But the entire planet's normal daily trading volume is just over 8 million ounces. They'd need to buy over 33 times the world's daily supply every single day. It's just mind-boggling. And that immense, overwhelming buying pressure is exactly why the bank's own models, according to the source, projected the price of silver would absolutely explode. Their baseline projection was allegedly $267 an ounce. But the documents supposedly warned of something even more dangerous. They called it a worst-case scenario. And this is what would happen if other big banks who might be in a similar jam were also forced to start buying silver at the very same time. That would create a frantic, competitive scramble for a very limited supply. And that's exactly where this alleged internal crisis at one bank threatens to spill out and become something much, much bigger, potentially triggering a wider, systemic event across the entire financial system. The key concept they're talking about here is a kind of domino effect. It's called cascade covering. So think of it like this. When a huge player like Citigroup is forced to buy, that pushes the price way up. Well, that sudden price spike can then force other big players who also bet against silver to start buying too, just to cover their own losses. And that creates this incredibly dangerous feedback loop where everyone is buying at once and it just sends the price to the moon. Here's another really critical point the source raises. They talk about a potential split between the paper price of silver that you see on the exchanges and the price for actual physical silver, coins and bars. In a panic like this, the source claims the price for the silver you can actually hold in your hand could be 30 to 40% higher than the paper price. Now, according to the source, this isn't just a Citigroup problem. The document allegedly states that Lloyd's of London sent similar insurance cancellation notices to other major banks too. And if that's true, it would force a coordinated, simultaneous rush for the exits, with multiple financial giants all trying to buy back their silver positions at the exact same time. So let's just quickly recap the incredible claims from this source. We have an alleged leaked document that details an emergency liquidation of a 6.3 billion ounce silver position. We have a mandatory deadline that's supposedly driven by a triple whammy of insurance, credit, and legal crises. And we have the bank's own models reportedly showing that this action is going to cause an explosive price rise with the terrifying potential for a system-wide cascade. And all of that leaves us with one final and, I think, really crucial question. We've laid out the extraordinary claims from this alleged leak. Now, whether this document is real or not, it forces us to ask a very uncomfortable question. How many of these massive hidden bets exist in our financial system right now, just sitting there, one crisis away from spiraling completely out of control? What does it say about the stability of our economy when one bank's secret problem could potentially unleash chaos around the world?